Good afternoon from Eagle Financial. Friday afternoon after the market closed. The big story of the day, or the big story of the week, coming from Trump's tweet, quote, a very substantial phase one trade deal with China is in the works. So today we had the Dow Jones up over 500 points up until about a half hour ago, about 15 minutes prior to the close, and a big story came out that U.S. Special Forces were accidentally bombed by Turkey in Syria. So we've been getting our troops out of Syria. We had some more Trump commentary that Bill and I were discussing on Monday about Ankara and Erdogan, making some wrong choices over there, and it's a really complex, difficult scenario to figure out who the bad guys and who the good guys are. But it even differs among our political parties here in America. But you know, it looks like some of our special forces were accidentally bombed and took a little bit of wind out of our sails late here with the market. But you know, we've seen a tremendous amount of market volatility across the board, back and forth. The U.S. stock market has been very schizophrenic. Most of that has been coming on rumors and tweets regarding economic news and mostly China trade issues. So it looks like something's in the works. It wouldn't surprise either of us at all if we come in here Monday and there's something, you know, to counter this. And it wouldn't surprise us if there's more good news. So,
well, you know, Jack, as they say, you know, the truth is in the details, and so the market is up on this news about some trade breakthrough, but we really have to see what's in the details, and it may not be enough to continue this move higher.
And we've commented on this, though. The most important thing for President Trump to be reelected, we're not saying we want him reelected, most business people do though, is it's all about the economy. So, and the economy really hinges tremendously on trade, and especially with one of our large trading partners, you know, China. So we have markets edging up after being down Monday. Huge rotation out of bonds and into stocks. So we wound up today about a 1.25% across the board, and that's about where we wound up for the week. Interestingly, though, you know, another big story today was the Treasury yield curve uninverted, Bill. So you know, that's more talk again. Excuse me. Forget about recession. The 2-year Treasury note yield climbed this week to close today at about 1.65%, but the 10-year note yield was 1.76%. So clearly that's an 11 basis point differential, and we were actually inverted, you know, yesterday. So that's a good sign. There were tariffs on China that were going to go into effect next week, and that's not going to happen. So as we said, S&P 500 up about 1.25% on the week. That's 19.5% year to date. You know, most of that came in the first quarter, but we've had very small incremental gains in Q2 and Q3. West Texas Intermediate crude closed up $1.11 to 54.67. Good for the oil patch here in Louisiana. Gold down about 10 on this news at $14.90 today, and that pretty much gives us a market wrap. So what are we going to talk about today, William?
Well, we made a couple of Facebook posts last week, and just to remind our viewers, one of the posts was, you know, on the back of National Black Dog Day. I found it humorous that I came across the existence of an exchange-traded fund, or ETF, that invests in the animal healthcare sector. And then another post we made had to do with Charles Schwab and their battle with their peers over the reduction of commissions on online trades. And Schwab kind of led their peer group by taking online trading commissions to zero from $4.95. And their peers like TD Ameritrade and Fidelity and others did follow suit. So I thought that it would be useful to talk about an area of the market that has been getting significant attention in recent years and that should get more attention now that these big brokerage firms have cut commissions on online trades. And that is exchange-traded funds, ETFs in general. If you're not familiar with an exchange-traded fund or what that is, just to give you a little background, the first ETF was introduced in 1993, the SPDR S&P 500 Index Trust. It's still in existence today. It may be the largest ETF. It's definitely one of the largest. And it's designed to track the performance of the underlying index, the S&P 500. Most of the early ETFs that were introduced were designed for that purpose, to track large stock indices like the S&P 500, Dow Jones Industrial Average, etc. But over the years, these have exploded in popularity. So there are ETFs for every conceivable underlying benchmark index, sectors, industries, geographical regions, investment themes, you name it. There are over 2,200 ETFs that trade in the U.S. alone. Globally, that number is about 5,000. And in the U.S., there's approximately $4 trillion in assets in ETFs. So this is a huge sector of the market. And it has kind of spurred this debate over active versus passive investing, as many investors have taken the passive route and taken money out of actively traded mutual funds and put that money into passively traded ETFs. And so we have seen huge flows out of actively traded mutual funds going into ETFs. So what is the difference? I mean, both of these are investment vehicles, ETFs and mutual funds, but ETFs are a different animal. They do trade intraday like stocks do. Mutual funds do not. So when you buy a mutual fund, that trade settles at the end of the day, at the close. ETFs can be traded on margin. They can be shorted. They have full transparency in most cases. So you can see what's held inside of an ETF on any given day. That is not the case with the mutual fund. And in most cases, ETFs have lower operating expenses than their mutual fund counterparts. And they also tend to be more tax efficient. So for all of those reasons, ETFs have been very popular in recent years. But we do want to talk about some of the pitfalls. You know, ETFs are not the panacea for everyone. And there is this misconception out there that ETFs are lower risk because they're lower cost and they're diversified. And I would just simply answer to that, no, they're not necessarily lower risk. With any ETF, you are taking market risk. And you need to understand what you own. You know, for some investors, they just want to put money into a passive ETF and forget about it. Set it and forget it. Leave it alone. Well, that's fine, but the problem is, as I said, you need to know what you own. You need to know what's inside of that ETF, because you are making an active decision to invest in the underlying holdings of that ETF.
Bill,
Yes,
I
go ahead.
might add too, you know, we've been in this bull market now for about 10 years. And the longer a bull market goes, a lot of individual investors think that it's easy or it's
True.
easier.
That's true.
So we have this trend to go more passive the longer the duration of the bull market, right at a time when perhaps the markets are a little bit more risky. They're higher, more risky, and
That's exactly right.
so conversely, when we've had market corrections, investors are going to be more prone to trusting in investment advice and using active management.
That's exactly
I'm sorry,
right.
keep going.
No, that's good. And Jack, you kind of just touched on one of the pitfalls with ETFs, and that's hot money. And so as more and more assets go into passive exchange traded funds, when we do see market declines, you can expect to see large outflows out of those passive ETFs. So there are a lot of investors out there who are market timing with these ETFs. So the hot money will come in, and just as quickly as it came in, it will come right back out. Now, there are a few other things that I want to point out with ETFs. One is tracking error. You know, as I said, these ETFs you can find an ETF for anything, but just because an ETF is benchmarked to an underlying index does not guarantee that it will successfully replicate the performance of that underlying index. And this is particularly the case with ETFs that trade in commodities and currencies, and even over-the-counter securities like bonds. Bonds?
That's a good one.
With
Yeah.
on any given day, that particular bond that you're looking for may not be available, but that index is still trying to the ETF is still trying to replicate the index, so it's having to invest in substitute bonds because it cannot find enough or the types of bonds that it would buy otherwise.
Especially in the muni space where you have hundreds
Absolutely.
of thousands of issuers,
Absolutely.
you're going to have a big tracking error. Yeah.
And the other thing is, you know, the hot new thing. You know, I did joke about the animal healthcare ETF, but the fact is there are ETFs coming to market almost every day, and the thematic ETFs are some of them. It's just absurd. I mean, if you want to invest in cannabis, as I mentioned, animal healthcare, obesity,
Socially conscious investing.
Catholic values. Hey, there's a fund for that. There's an ETF for all of those things. So we would not necessarily want to put anyone into an esoteric, exotic ETF. You really have to ask yourself at the end of the day, does this ETF fulfill a useful purpose in my portfolio? And if not, we would advise you to steer clear of those. By the way, there's about 100 ETFs a year that close because there's just not enough assets coming into these funds. And I was really surprised, Jack, when I read that about half of the inflows going into ETFs go into less than 1% of the funds. So that means there are a lot of really small ETFs out there, and those are ones that you should probably avoid. Now the last thing, you may be wondering, well, do we use ETFs, and how do we use ETFs? And Jack, I'm going to put you on the spot here, and why don't you share a little bit about how we have used ETFs here at Eagle Financial?
Well, we've kind of used just for basic market exposure. ETFs are wonderful, are wonderful investment vehicles to get market exposure in any place where we want to get market exposure or market beta, and very inexpensively. And we can also come or go whenever we want to. We don't have to wait till the end of the day. And then we would call that core exposure. And then we could also do some of these interesting satellite type ideas or thematic trades or all kinds of different things. You've given many examples, but
well, like for example, if you want broad market exposure, and let's say you buy the S&P 500, well, just because of the way that index is constructed, you are underweight certain sectors of the market. For example, energy. You would be hugely underweight energy, And so you may want to beef up your exposure to energy, and so you would buy an energy ETF and make that a satellite position within your portfolio.
Yeah, I think there's another way to look at that, though, too, Bill, is that, at the energy peak, the energy sector comprised, I think, about 19% of the S&P 500 at its peak, where it's only about 4 or 5% today. So, that's, of course, there's more than one way to look at that, but you're exactly right. So that's an area that we happen to think looks really good for the long haul and is very inexpensive. So we can indeed get additional exposure through ETFs or individual stocks, or ETFs is the best way to do this in a diversified approach. You could also use open-end mutual funds, like you said, and closed-end mutual funds that could be another conversation, that trade at a discount to net asset value.
I would say that our approach here is that we are agnostic when it comes to the selection of the investment vehicle. An ETF is a vehicle, a mutual fund is a vehicle, a unit trust is another vehicle. There's different types of vehicles that we can use to get exposure to areas of the market. And so we look at all of these factors of these different vehicles.
Yeah, and just to give you one good example, I mean, we have probably our biggest ETF position, I'm sure it is stock symbol SCHB, that's the broad U.S. stock market. The expense ratio of that is only 0.04%. So you have market exposure virtually free. We buy that without commissions, transaction free to come or go any time of the day. You own the S&P 500 mostly embedded in there, but you also have exposure to the broader U.S. stock market. So you have the whole, that's a representative of the entire U.S. stock market in one investment vehicle.
That's right, Jack. And I know we're about to wrap up, but I will say this, concerning the active-passive debate, because Jack mentioned that during this bull market in the U.S. stock market, it's been very easy for people to generate good returns passively investing in the market. Active investing will have its day. And as we progress through this economic cycle, and we are in agreement that we're late in the cycle, active managers will, I believe, outperform the broad market. And so this is not a time to just be blindly throwing money into the market. You do need to be more selective. And that's something that active management can bring to the table, looking at the underlying fundamentals of the holdings. Because passive investing really has evolved into more of a momentum type investment approach where those companies that are just generating the best returns get more attention. But at the end of the day, it's not necessarily which one is generating the most returns. It's which one do you expect to do better going forward.
That's good, Bill.
Well, we also have to apologize. We had a brief interruption that our assistant notified us about. And Jack, that was your brother calling, by the way. So you need to call him back and tell him don't call us during our Friday afternoon Facebook Live.
Okay, lastly, I'd like to say the Tigers are a 13.5-point favorite. They're in Baton Rouge tomorrow night playing the Florida Gators. That's the 5th-ranked LSU Tigers against the 7th-ranked Florida Gators. High-powered offense against a stingy defense. I think the high-powered offense at LSU wins out big. What do you think, Bill?
I believe LSU will win. I think covering that spread will be a challenge. I mean, Florida will be stingy, but in the words of Ed Ogeron, go Tigers.